Okay, this is Business 436, the handout Understanding Financial Statements. We've already done the balance sheet and the income statement. So what we'll go to is the cash flow statement, which is the third of the financial statements. Remember, there's a balance sheet, income statement, and cash flow statement. Cash flow statement's on page 33. It starts out saying the cash flow statement, the last of the three essential financial statements, is the least used and least understood. The statement details the reasons that the amount of cash and cash equivalents changed, the reason for that the amount of cash and cash equivalents changed during the period. Like the bank statement you receive for your checking account, the cash flow statement tells how much cash was on hand at the beginning of the period and how much was on at the end. So it's good to kind of compare it to a bank statement. The uses of cash are recorded. So when you use cash on a cash flow statement, it shows up as the negative, and the sources of cash are recorded as positive. So if you've got increases in cash. Now, I think I've mentioned it to you once before, but people don't think about cash flow in a business. They think about profitability. But just think of it this way. Say you're a company, and at the end of the year, you sold $1 million worth of product in December, but you're not going to get paid that money for 3 months. Okay, just to use it as an example. So your income statement at the end of December, the way you book profit is that you ship the items. So it shows the profitability on that $1 million worth of product that you shipped to a customer. That shows on your income statement. So you have positive income, net income. But as far as cash flow, you paid for those products you shipped. You paid to ship them. You paid for the materials. You paid for the direct costs. You shipped them, but you do not have the cash for them. So now you got to make some more products in January for customers, and you still don't have the $1 million that you sold those products for. Where do you get the cash for the to pay your suppliers that for the products that you ship? Cash flow can be a huge problem. You can be very profitable and have a horrible cash flow, which basically usually amounts to your accounts receivable taking a long time to collect. And that could be a problem. You could be almost unprofitable, but with a great cash flow and stay in business. You've got to have cash to pay your bills and your salaries and your rent and your utilities. So if you're having a problem collecting money, that's a big problem. Okay? So basically what the cash flow statement tries to do is reflect that. Down at the bottom here it says the cash flow statement is useful because it indicates whether your company is turning accounts receivable into cash. And that ability is ultimately will keep your company solvent. Solvency is the ability to pay bills when they come due. Okay, so people don't look at it a lot, but cash flow is a big deal. So they give you a little formula up top of the page. Cash flow from basically this is how you figure out cash flow. Cash flow from your profit plus other sources of cash minus uses of cash equals your change in cash. That kind of makes sense, right? So here's a sample cash flow statement. It doesn't go all the way to the bottom. I'll try. There we go. Okay, so net income for 2002 was $347,500. Now remember, when there's a negative, that means you're using cash. So accounts receivable negative 75,600. So what does that really mean? It really means that your accounts receivable went up because you have a higher accounts receivable than you did at the beginning of the period. That's a use of cash. If your accounts receivable went down, that would be a positive number like this, which means that you collected that cash in accounts receivable more than you took on new receivables. Finished goods inventory. Remember, negative means it used cash. So what does that mean? Does it mean that you have more inventory now by 125,000 than before, or that you sold more product and got cash? Well, if this is negative, it means it used cash, so it means your inventory went up by 125,000. That's a use of cash. If it would be positive, if it was a positive 125,000, it means you sold 125,000 more in inventory than what your balance was before, and you got the cash. So that's how to read these things. Accounts payable, this went positive. So that means that your accounts payable went down because accounts payable is a usage of cash. So this is positive, so that it means that they went down because you didn't have to pay as much. So it's kind of contra to what you think. Income tax payable went up because you used cash, or you used more cash. So then basically you take all the cash flows from operations and actually went higher than lower in this case. Excuse me. Your net income minus, these were all put together, were a net 63,600 use of cash. So cash flow from operations is 283,900, which was this 347.5 minus the net of all these, which was a use of cash of 63,600. Investing activities, the sale of a property, plant, and equipment, of course, that would be positive cash. You're getting 267,000 in cash. Capital expenditures, money, cash that you're spending, 175,000. So the net cash flow from investing activities was an additional 92,000 in cash. So you would add this and this right now. And then financing activities, short-term debt increase. That went down, obviously, because it went positive cash. Long-term borrowing went down. Capital stock went down because it's an increase in cash. Cash to dividends, remember, when you're giving dividends, that's a cash outflow. So the net of all of these things is a positive 2,000. So you take this, subtract that to get this number, add this number, and you get that's 377,900. So basically your cash went up. The amount of cash flow that you have went up, which is good. It says the cash flow statement doesn't measure the same thing as an income statement. If there is no cash transaction, then it cannot be reflected on a cash flow statement. Notice, however, that the net income at the top of the cash flow statement is the same as the bottom. So the net income from your income statement is the same as the top line. It's the same as the bottom. The net income at the top of the cash flow statement is the same as the bottom line of the income statement. It's company's profitability. Okay, and then they talk about various activities. Accounts receivable and finished goods inventory represent items that have been produced but for which it has not received payment. Prepaid expenses represent items the company has paid for but has not consumed. These are all subtracted from cash flow. So when your inventory goes up or your accounts payable goes up, your cash flow goes down because you haven't gotten that cash flow, right? Accounts payable and accrued expenses represent items the company's already received or used but for which it hasn't paid. Consequently, these items add to cash flow. So when those go up, it adds to your cash flow. At some point, you're going to have to pay for them, though. Gains realized from plant sale and property equipment. We talked about that. If you sell something, that increases your cash flow. If you buy plant equipment, it decreases it. Cash the company used to invest in financial instruments, in plant and equipment. You know, it's a cash outflow if you're spending it, cash inflow when you're selling it. So then you look at the statement, and you had it talked about what was on the additional cash on the cash flow statement. Okay, so here's a reiteration of what I said before, and I'll just read this word for word. For many people think of profits as cash flow. Don't make this mistake. For a particular period, profit may or may not contribute positively to cash flow. For example, if this year's profit derives from a huge sale in November, the sale may be booked as revenues in the fiscal period, thus adding to profit. But if the payment for that sale is not received until the next accounting period, it goes on the books as an increase. It should say an increase in accounts receivable, and that reduces cash flow. Okay? It says finally, we come to cash flow changes from financing activities. They talk about the dividends getting paid out, which obviously is a negative cash flow. So cash flow is important. You'd like to see a business with cash because then you know they're solvent. They can pay their bills. All right. That's the cash flow statement.